Right, everyone, welcome to the live webinar, the first one of the full trading week of the year. And it's going to be really good because we've got all the latest data that you need. We've crunched a load of numbers. So we're going to start straight away. First things first, let me know you can see and hear me in the room. I trust everybody can. And I can see Kishan, Sammy, Stuart, Sven, Fred, everyone else. Put it into the chat box that you can hear me, and let's hope that the audio for a change is working. Okay, so that's the first thing. The second thing is I want to share my screen with you. Here we go. We're going to share the screen. And hello, Alan, loud and clear. Chaz, what a relief, because it always is a relief. You can all hear me. First things first, this is not financial advice. It is financial education. It is not individual financial advice to any of you. And also, it is not a solicitation to buy or sell any individual stocks. I have to tell you that, not just for legal reasons, but because it's also the truth. The next thing is, don't forget to have a look at campaignforamillion.com. All the resources, the tools I'm talking about, all the free tools, downloading a free copy of my book, free articles, in-depth, deep dives into the things I'm talking about, are all on the website. And basically, we've summed it up there. What's the point of the site? And what's the point of all these webinars? A campaign to create more investing multimillionaires globally out of regular non-investors. It's as simple as that. Okay, it is as simple as that. And it's been my life's mission from all my TV shows, Bloomberg TV, Financial Times, all the rest of it. So campaignforamillion.com. Try that. Now, where are we? Let's first of all do a January update, as it were. It's only, we're not even at the end of the first week. The Dow has jumped nearly 600 points to close at a record. And that's because the markets have rallied after the American military action, special operation, police action, call it what you want, in Venezuela. The great thing is, at least this time they were honest. It's all about the oil. No kidding. Cuba's next, and then Greenland and all the rest of it. Anyway, I'm going to talk not politics. I'm going to talk stock market, because that's what we're here for. We've got to keep focused because you've got better things to do. So bottom line, obviously the market likes it. Maybe the market thinks the American companies are going to get their hands on $17 trillion. The customer is always right. The customer is the market. Don't try and outsmart it. Don't outthink it. Don't think that you know better. It's gone up 600 points. People with money, and in the stock market, they're the only people who matter. The market's not ethical, it's not moral, it's not socialist, it's not communist, it's capitalist. So therefore, the only people that matter are the people with money, and the people with money have just bought a load of stocks and pushed it up 600 points. You might think you're more clever. The market is not an intelligence or IQ test either. It's a group of people with money. Money doesn't buy brains or beauty. It's not a beauty contest. Okay? Don't confuse it with Miss World. Don't confuse it with Mensa. It's none of those things. Don't confuse it with, I don't know, a course in ethics. It's jumped 600 points. That's what it is. That's the reality. So where are we at the moment? Now the serious work begins. All that December, we're on holiday, doesn't really matter. All of that doesn't matter. Now companies are going to have to deliver. So holiday optimism gone. Now we're going to start looking at numbers, hard numbers, like 600 points up on liquidity, i.e. real money, not December. There's one bloke in the office who's clicking some numbers. No, now it's real money. Let's talk UK first. Now, most of the money at the moment in the early start of this year has so far gone into UK banks and energy companies. We do not chase sectors. We don't chase narratives. We'll look at the underlying companies to see if they are worth getting into, because sectors and chasing narratives, think of it the scientific way. Is there a hypothesis which suggests that that leads to higher moving prices? Have you tested it? If not, you're just gambling and speculating. And we're not here to gamble and speculate. This is investing for our pensions. My son's ISA and SIP and inheritance is at stake, so there's no messing around. Okay, so whilst that's where the money seems to be going so far, early days of this year, okay, and it seems to be, from everything I'm reading, the bankers I'm speaking to, the people with money, the only ones who matter, that the money is going towards value-orientated sectors rather than just speculative growth. Now, that's partly because there isn't much speculative growth in the UK markets. It's basically a bunch of mining companies and banks and energy companies. So you are really left with that as a safe haven almost. Okay, I'll talk a bit more about where that's going in a moment. But for now, that's the overview. Okay, US, it's strong. Mega cap stocks still look like they're going to go ahead. However, it's fragile. What do I mean by fragile? Well, it's the big companies that are leading everything forward. The 2 M's, the 3 A's and N. Meta, Microsoft, Apple, Amazon, Alphabet, Nvidia. The mid caps, the ones below that, which are multi-billion-dollar companies, they're obviously not getting those kinds of returns that the big mega cap companies are getting. I want you to think of the mega cap companies as monopolies. They've got a monopoly on talent. They've got a monopoly on markets, and they are the economic equivalent of Donald Trump. In other words, they can blast their way anywhere in the world and destroy all other competition because they can outcompete it. Amazon can destroy your retail business by just undercutting on prices because it can run a loss longer than your cash flow can sustain competing with Amazon. Simple. Think of them like the modern day East India Company of Britain. Companies like the Dutch East India Company, the British East India Company, they go to foreign countries, suck out the resources, do a little bit of usefulness at the fringes elsewhere. But overall, it's all going back to the motherland. The motherland is no longer Britain, it's now America, and these companies are taking that capital. Don't complain about it. Ask how you can get in on it. You become a capitalist, you own the shares in those companies. And those mega cap companies, the key thing to look for is profitability. As long as they remain profitable, and I used to say this on my Bloomberg TV show during the dot-com bubble, the profits, if they're not there, then you're running on momentum. You don't want to be running on momentum. You can. You don't want to be running on it too long because you haven't got substance. These companies have got momentum and they've got profits. As long as those profits are there, we'll be fine and we'll keep an eye on those profits for you. So it is strong but fragile. I'm okay with that for the moment. I keep holding those stocks I've just mentioned. They're also in my son's portfolio, and I'll come across some more stocks. I'll mention them to you in a second. The biggest risk is going to be complacency, and I'll tell you why. We're not at euphoria. 600 points on the Dow might suggest to you that we are at euphoria. Complacency, where people think, well, about 3 years of a bull market, this is going to keep going up. No. Companies which don't deliver on profits, and remember, in Britain, earnings announcements are every 6 months. In America, they're every quarter, every 3 months. If they don't deliver, they're going to drop 20, 25%. Don't panic. If you're British and watching this, don't panic. You're not used to those kind of drops in a day. In Britain, if those drops happen, you should dump the stock. It's not going to ever recover. In America, if those happen, usually if it's a good company, you can just buy the dip and it'll recover. Americans punish their companies. Why? Because they've got more choice than we have in Britain. Okay, and they've got a more active retail investor base. So they punish them immediately straight away, and then you get a bunch of dip buyers coming in. The bottom line being keeping calm is going to be important. Expecting sharp falls is going to be important. Expecting those sharp falls to rebound is important. What's the key macro scenario we're at? Interest rates are no longer the biggest story. What's the biggest story is, have interest rate cuts stopped? No, they haven't, as far as we can tell so far. The moment you get an inkling from either, well, actually the Federal Reserve in the US, that there'll be no more cuts, then you can expect a 2022 type of fall. We're not at that at the moment, so calm down. Equally, the interest rates and the background economy will not rescue companies with poor profits. Those companies with poor profits are not going to get away with it on the basis that everyone thinks, hey, it's okay, dot-com kind of era bubble. No, they'll be punished because there's choice of companies with profits. There's a lot of companies which are very profitable. So why would you stick with ones which aren't? We're always going to pick profitable companies, and companies which are growing profits and revenue as well. And companies which don't have lazy valuations. In other words, which are not overvalued. Okay, because everything else is going to get punished. It's going to get punished hard in this market because there's a lot of good choice out there. Now, gold, people are talking about it. Gold is at all-time highs. It's really institutions. It's not euphoria. It's not momentum. It's institutional buying, real buying, and it's China. It is not panic buying because of some kind of crisis either, right? So there is substance to this, and I'll come to gold in just a moment. This is an overview of January and an agenda for the rest, and what we're holding, what we're buying, what we're seeing money to be made of, and how we've done over the last year. I'll come to in a second. Oil, it's not too high. Anything over $80, worry for the stock market. Anything below $50, there's a problem. We're in range bound, we're fine. It's benign. No news is good news. So that's a quick summary of sort of January. Let's move on. Two things, remember, wherever you are in the world watching this, if you're in America, you've got two choices: traditional IRA or Roth IRA. If you're in the UK, SIP or ISIP. In Australia, Canada, wherever else, similar kinds of choices there as well. Okay, so for those who don't understand this, I know 99% of you will, and put in the chat box, by the way, everyone, where, if this is your first ever webinar, just so I know, and also put in if you manage your own SIP and ISA, and if you don't, just let me know more about you, because the more I know about you, the more I can sort of help you, as it were. Now, the two tax-free vehicles are SIPs and ISAs. Why? Because profits grow without tax, and it's great. And this is how they work. I'm not going to read everything on screen. You can take a picture of it. If you've got a camera phone, I suggest for this webinar, you take pictures of the screenshots, or take screen grabs if you're a bit more sophisticated than that. But I thought I'd sum that up for you. And of course, you can invest outside of that, because the amount you can put into SIPs and ISAs, all these tax-free wrappers, is piss poor. It's so low. It's not like it was 20 years ago, where I think at one point it was unlimited. Government's caught on. They realized, hey, hang on, we've got to tax the crap out of people. If people are having too much fun, got too much money, let's find a way of stopping that. Basically, that's how governments work. Somebody's getting too rich through some scheme, getting too happy, F it up. Yeah, motorists, they seem to be having too much fun. Reduce the speed to 20 miles per hour. Anything to make people miserable. Okay, so where are we at the moment with this? You might end up holding things outside of your SIPs and ISAs, which increasingly I'm seeing with clients they are, because the tax-free allowances are so small. So whether they've got it in a company or individually, it's becoming even more tax efficient, sensible to invest rather than trade, because trading, you're going to get taxed each time you've got profits, whereas investing, you're holding for a longer period of time, so you're not going to realize a gain for longer. Of course, you're still going to get taxed, but at least it compounds internally, and not giving, if you're selling all the time at a profit, giving 25, 40% away, right? So just so you know, we've got a lot more clients who are now investing through companies and externally through non-tax shelters, because the tax shelters, as I said, are so piss poor. Raj said, I manage my ISA and SIP. Stuart, ISA, I don't work enough hours for a SIP. Glenn, SIP, ISA, workplace pension, I control them all. Good. And then got Andy, manage my own SaaS with an AJ Bell account inside, so similar setup to a SIP. Yep, I fully understand. If you're using foreign currency investment, so you've got a SIP and you're investing in US stocks, the thing you've got to be aware of is interactive broker, interactive investor will keep it in US dollars each time you sell it and say buy another stock. The others will keep transferring it back to sterling in a SIP. The reason that the others do that is they can, like AJ Bell, they can keep charging you currency fees. So just be careful. You might want to look at other brokers, and you can easily transfer from one broker to another. They do it internally, and they're desperate to do it because guess what? They want your money. Okay, so that's just a reminder of that. Now, I'm going to talk specific companies. As you know, this is how we do it. Getting straight to the point. 10,000 companies, filtered down. These are the ones which I say multifamily because it's not just my son's portfolio, it's other members of the family, essentially chosen from a universe of companies which are undervalued, strong growth, good cash flows. Croki comes from cash flow measurements. Goldman Sachs Wealth Management says companies in the top quartile, which is basically anything above about 10% cash return on capital that they invest, are in the top quartile. They generate 30% per annum. Momentum, up over 6 months. Sortino, high average returns, low downside falls. We'll dip into that in this webinar as well, and the kind of companies we're looking at for that kind of stuff. But that's essentially what we want in the portfolio. If we could look in even more detail, I would say to you, here's the one stock. We can't do that. Not even Warren Buffett can pick just one stock. It'd be too risky. That's why you have a portfolio, and we're looking at about 20 to 40 stocks. And the more risk averse you are, the more percentage of your capital is in cash. Very simple. If you're young and risk loving, you have 10% in cash. If you're 80, you probably have 90% in cash. Very simple. Okay. More cash you hold, the less risk you're taking, because cash is certainty, and the rest is in equities, and you're probably going to have 20 to 40 equities. You might have one or two index trackers like a FTSE, a World All Share in emerging markets, an S&P 500. There you go. There's 4 names already. Can't go too wrong. You're going to have some gold because you feel FOMO, even though it's quite late. You're not doing it to trade gold. You're doing it just to have 5% anchor in your portfolio. Fine. If you're going to have some Bitcoin for fun for the very long term, maximum 5% if you don't have to. Okay, you don't have my risk appetite, I don't have yours. So don't try to be somebody else. If in doubt, leave it out. Very simple rules. Now, let's turn, before we go into individual stocks and the market outlook and what I like, let's go to AI and where we are. That's one of the big questions for the year. Boom or bust and bubble and all the rest of it. Okay, so there's 2 views on this. Quite frankly, I don't care which of these views are right. I'm not gambling on one view or the other. I'm not going to Ladbrokes and say, I think this will win, this will win. What I'm looking at is individual companies making sure they keep making profits out of this. This isn't my problem whether there's a boom or bust. It's Microsoft's problem to solve, and I'm a shareholder in Microsoft, and I delegated Microsoft's board of directors to make the most money for my son and me. Same with JP Morgan. I've delegated to Jamie Dimon. Make me some money. That's why I'm a shareholder. I don't become a shareholder in there and hire somebody like Jamie Dimon. That's what a shareholder is in a company. You've just hired all the employees and then say, let me tell you what I think you should do. That'd be a stupid move. You don't buy a dog and bark yourself, as they say. Stuart, you can't own crypto in an ISA or SIP in the UK. That's right, Stuart. You do it outside. As I said, a lot of stuff you're owning outside. You can do it in an ETF, Stuart. And there are Bitcoin ETFs. I'm not saying you do crypto anyway. Okay, I wouldn't want a crypto in my pension. I do it for fun. I don't want Vegas in my pension. Okay, I don't want Ladbrokes and the 450 at Kempton Park in my pension either. Awesome. When your Alpesh extension coming to Sheska, I don't know. Stuart, if you buy US stocks at the moment, you get more shares if the dollar is weak, but you want the dollar to be high when you sell. I consider the dollar to be another asset I'm holding for diversification, just as I might own some rupees or some gold. Just another security. So I don't care because I'm holding for the long term. If I needed to exit in 12 months for anything and I needed money in 12 months, I'd hold that money in cash. Money I need in 12 months or 24 months, I just have in cash. It's really simple. Anybody who says, oh, I need this money back in 12 months, should I invest in the stock market? They're actually gambling. And retail clients are the biggest gamblers in the world. Not institutions, not people like me, retail clients. And you know what proof there is that they're the biggest gamblers with their money and the massive, irrational, speculative risk takers? There's a Ladbrokes on every bloody high street in Britain. Okay? Retail clients, they're just gamblers. And part of my job is to hone that in and get them on a tighter leash to stop them blowing up their life savings. Okay, Coltner just transferred SIP to a new account, having come out of managed funds. Need to reinvest it. It's currently in cash. Next, we'll be transferring ISAs. Makes sense. Interactive investor in dollars. Good. Manage my own SIP. Have an old workplace pension. Perfectly fine. Just keep an eye on your workplace pension. Make sure that they've not put you in a default fund, because 99% of times that won't be suitable for you. So where are we? Is it different this time? You can see the arguments. Okay, so the arguments are, and I'm inclined towards AI is being underestimated in terms of profitability. I'm not the only one who says that. Eric Schmidt, who used to be number 3 at Google, says it. He's the CEO. Okay, and he knows his stuff, but I also think it's been underestimated. But we're always aware of the fact that there are some warning signs. The AI rally at present is bigger than historical bubble. Valuations is near .com peaks, concentration in a few companies. All of these things you're going to keep hearing, and people try and scare you. And again, as long as companies are making profits and the share prices I'm keeping an eye on, I'm happy. 99% of the time this year, I'll be doing nothing like every other year. It's why I've got a fat belly, okay? Because 99% of the time, I have to do absolutely nothing other than go to the gym. In fact, at my gym, I'm going to suggest they just put stock market news up there. 2 for 1. We're laughing. I'll do some of these broadcasts from there. That'd be quite sensible, actually. Gee, that's a clever idea. Now, there's these are the worries people are going to come up with. This is noise in your head to play with you. Your brokers, your fund managers are going to try and feed you as much of this as possible, and as a journalist, because they all make money by you doing things. I'm the only one who will make money for you by you not doing anything. They make money by you doing stuff. Journalists, because you click on stuff, they get ad revenue. Brokers, because you buy and sell stuff, they get commissions. Fund managers, IFAs, because they feel valuable and they take a percentage of your assets under management. I don't do any of that. Okay? So be careful of the narrative. Who's going to be winning in AI? Well, I'm not about to invest in Chinese companies. I've many a time been in Shanghai where they give me massive presentations in Mandarin. I don't understand a bloody word what they're saying because there was no translator. I say, thank you very much. I think I've got enough stocks to pick from. If I look at the US, Europe, and UK, I've got 10,000 equities to select from. If I can't blooming pick something out of 10,000 companies, none of these make the cut, by the way. Out of 10,000, we whittle it down to 200. The best 200 candidates. Like we're Oxford University, we've had 10,000 global applicants and we're only going to let 200 in. We just keep raising the bar until we think we've got the best 200. Even then, not everybody gets a first. Just shows you, even the experts can't. That's why you let more than one student in. Okay, that, and you make more money if you let more than one in. Now, none of these make the cut. You've got everything. Look, you've got everything from every sector, every exchange, London Stock Exchange, Europe, NASDAQ, okay? So it's not just that British companies don't or do or whatever, but out of 10,000, you'll end up at this, okay? If you do not have high standards, don't be surprised when your portfolio doesn't deliver high returns. And if it does without high standards, you got lucky, you're about to blow up the year after, but it's going to happen. High standards. That's what you need in a portfolio. That means highest growth matched with the lowest valuations, matched with the highest cash flow, matched with the greatest growth in revenues and earnings, matched with strong momentum, matched with high average returns on the stock price, and shallow falls with quick recoveries. Those are the characteristics of what you want, obviously, self-evidently, when you think about it. If you want to speculate, which I do not want to do, then hey, go spend your day on Twitter and Reddit and see if somebody comes, actually in a pub or the back of a black cab, maybe somebody will throw you a bone, or listen to some journalists or some breathless newsletter. And you're more than welcome to speculate. I suggest you do it at Ladbrokes and at Vegas rather than with your pension. Now, artificial intelligence, it's their job to solve the problem for me. It's not my job to make the money out of artificial intelligence. I wish I was that clever. I'm not. That's why I buy shares in other people's company run by people who are cleverer than me. It's that simple. Okay. Let's turn to gold for a second and we'll turn to specific companies going forward. Stuart, it's a good site. It's a good site. Just be careful with all the noise. Stuart, yeah, finance a bit dangerous. Now, I'll do the Q&A section at the end. Remember, I'm breaking these up into 15 minute. So 15-minute stock market update. We've already overshot that. 15 minutes a lesson in investing, and then 50 minutes Q&A. But the stock market update might take a bit longer, I think, today. Gold, this is what, I mean, take a picture of this. This is where the banks think the target is. What surprised me when I first saw this is how many banks all think it's going to basically continue higher. You know, I would have thought some of them might have said, no, it's going to drop back to 3,000, we'll equalize, we'll normalize, etc. No, you know, they're all saying this. It's the Chinese buying it. Now, we've got a family friend, now do not take this as gospel, who has been buying gold coins for, I don't know, 20, 30 years. And my wife bought some over 12 months ago, as you know, as I kept repeating over and over again. And gold coins are tax-free, no VAT, no capital gains tax. I wish she'd bought more in hindsight. Hindsight's a wonderful thing. But anyway, she bought some gold coins. They've done incredibly well. We spoke to him this weekend. He thinks it's going to go to $10,000 an ounce. Now, that is not what you want to hear, i.e., well, we've got a mate who reckons it's going to go to 10,000. You might as well just, the only thing is, I wouldn't be surprised if the bugger's right. I would not actually be surprised right now. What I'm But anyway, the most I'd ever put into gold, and I've written about this in the FT, so I'm not detracting from anything I've ever said. I'm not changing my tone or voice or view, which is the most I'd ever have in gold is 5%. Now, being of Indian origin, I was born with 5% gold held by the family. So in one sense, there's nothing for me to do. Oh, but it's too late. Yeah, I'm not trading. But Alpesh, you should have bought it sooner. Yeah, I wish I bought even more, actually. I wish I bought 100% leveraged. But this is where we are. And I'm not looking to trade it. Okay, so it's just there. If you wanted it. Well, and by the way, I don't have it as a financial instrument. We have it as physical gold. And it's not at home, so don't try and find out where we live. The investor's mindset. This is going to be one of your biggest problems this year. You're going to want to try and trade. What you're going to do is think, oh, I'll just get 7 or 10% out of something. And then I'll sell it and then I'll get something else. The problem is that you're going to mess it up. You don't have the skills. Just take my word for it, okay? The investing discipline is what we're focused on for these webinars, just so you know. The hardest thing you're going to find is sitting on your hands. Now, I wrote a book in 1997 called The Mind of a Trader. And in one of the passages was the hardest thing people find is sitting on their hands and doing nothing. In other words, retail clients, they're terrible at not doing anything. It goes against every ounce of human nature that we have in our minds and the voices in it and so on. So patience is going to be the thing, as every year, and removing that trading impulse. I hope you can read this on the screen, because I'm not reading every word on here, because I think I'm making the points fairly clearly on here, I hope. Okay, so if it's clear enough, it's a new way I'm doing things. Instead of me just yakking on, I'm sort of creating little infograms. And if you like them, then let me know, and I'll keep doing these to summarize the key points. But staying away from that trading impulse is going to be one of the critical factors, not in 2026, but every year anyway. Okay, so let's go back to the markets. S&P 500, it recorded third straight year of gains. Okay, that is rare. This is how it looks since 1994. By the way, 1994, I was working in the US Congress, and I was a young man with a lot of hair and a sharp, chiseled jawline, hadn't got fat yet, there was no pot belly. Anyway, forget all of that. That's a long time ago, as you know. Okay, some of you weren't even born then. Okay, Adrian, I bet you weren't even born then. Stuart, bet you weren't even born. Glenn, James, Copner. Now, that's not bad. Can we beat it? Can we consistently beat it? Yes, I'm going to show you how. It's very easy. Okay. And 3 straight years of wins. What happens when that happens? 3 straight gaining years. By the way, it's happened before. There. Oops. There. 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 Oh, so it happens quite frequently then, Alpesh. Yeah. Down years, pretty rare. I mean, that was awful. 3 down. I remember that period. And I was doing my Bloomberg show, and when I basically, my point at that time, if anybody remembers it from that time, the point I would make to Sally on the show each time would be, it's going to take a while for the market to forget and then recover back. Anyway, since then, we've only had 1 negative year at a time. And I think that's partly because the institutions have realized we don't want that. We want to start injecting capital into the market when that happens, as they did during COVID, monetary easing, etc., and coordinate with the rest of the world. Anyway, these are the Wall Street analyst forecasts for S&P. You've got everybody from Deutsche Bank, Morgan Stanley, Citigroup on here, Goldman Sachs, JP Morgan. So, take your picks. Pay the price and take your pick. So there you go. What does it mean? What does any of it mean? Well, the S&P closed just shy of 7,000 at the end of the year. Okay. The point being, ending at 8,100 would imply an 18% gain. So if Oppenheimer are right, if Oppenheimer are right, which is, that one, that's an 18% gain. Right? These would all be roughly 17 to 18%. If that were to continue at that rate, you'd be doubling your money in about 3.5, 4 years, which would be extraordinary. But actually, that's being the rate of growth. AI might be the impetus. I don't know. Let's hope it is, because we all like making money. But if it isn't, the kind of companies I've got are the type which if they fall, I'll buy more of anyway. So I'll tell you my strategy in a second anyway, whether the market goes up, sideways or down. The AI rally already outlasts many bubbles in history. Okay, am I panicked? No, I'm not, because my stocks keep bloody going up. So I'm not going to exit today just because in the future there might be a crash. In the future, the planet Earth doesn't exist. They just discovered the universe is contracting. Forget climate change and rising oceans. The freaking universe is going to finish. So live for today. And if the markets are okay, then you don't need to worry what's going to happen in 5 billion years, do you? Anyway, nice data. Let's put it into some graphics for you. 3 years of double-digit gains. What does history say happens next for this year? Okay, that's been the last 3 years. What's going to happen next? Well, 3-year streak of more than 15% is very rare. Since 1928, this has only happened twice. More than 15% per annum. It's just happened. And it's only ever happened twice before. Okay, case study 1 when it happened, dot-com boom. That didn't end so bad, did it? But we had 5 years of gains there. Flipping heck. Why did the dot-com boom happen? Why did we get 5 years of such amazing gains? Well, because the internet, a whole new technology, which every country, every company, every individual adopted. Every government, every individual, every company, every country. What's AI? Exactly the same. Some say more powerful and important than the internet. The internet was something which, okay, we got and then people didn't know how to bloody use. AI is actually something we've got, people know how to use thanks to the internet, and they're guardrailed in terms of how they can use it, in the sense that, okay, you got the internet and you started making freaking cat memes, pictures of cats, posting them. With AI, you're probably using it to do something more productive and bloody useful. Okay. Anyway, so there is potential for that. However, case study 2, COVID. 3 years of more than 15%, and then you had this massive virus, everything collapsed. What are we more like? Are we more like .com, or are we more like a virus about to hit us? I don't know what's going to happen. I can't guarantee the future. But even during COVID, the kind of companies we had, in hindsight, and you don't have to take my word for it, in hindsight, you were far better off buying the hell out of those companies when everyone else, as Warren Buffett would say, was fearful. So whether we get a COVID or whether we get this, I win. If we get this, I keep making money. If we get this, I keep making money because I'll just buy back a whole bunch of companies cheaper. The key thing will be not to panic and not to get bored. So you've got 2 precedents. The cautionary tale is don't panic if it goes in the red, okay? Now, let's look at the broader evidence. What follows a year like 2025? Bespoke Investment Group analyzed all years since 1928, where the S&P rose between 10% and 20%. 2025 was about 17%. There were 23 instances where this happened. What happens then? The median return is 11.8%. That's pretty bloody good. And 70% of the time you had a positive return. So I'm going to say 2026, I'm just going to go with the maths and the median return. I'm going to go with those numbers. I think there's a 70% chance of an 11% gain. I mean, I think my portfolio is going to do better because with an 11% gain, I think my portfolio should at least go up 22% to 40 at least. Why? I'll show you in a second why. Second analysis confirms this bullish lean. When the index posts at least 15% annual price gain, the average next year return has been 8%. History isn't guaranteed to repeat itself. As you know, let alone in the stock market, but just generally it's not. Look, we're in Trump 2. He's not repeated what he did in Trump 1. For a start, he went into Venezuela, took the president and said, I'm going to take all your freaking oil. Crazy world we live in. But, and this is where you're all going to mess it up. Forgive me for being harsh, but I think if I'm harsh, you won't then mess it up. The average maximum drawdown is 14%. That's at the stock, at the index level. At the stock level, it'll be almost double that, at least. People will panic. they'll end up getting out at the bottom. They'll start chasing narratives and stories and markets, and they'll keep getting all these voices from all these newsletters and social media saying sell, 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 buy, 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 and they'll start trading. Because there's a lot of people who make a lot of money by trying to get you to move and sell and transact. Even the government does. Okay? When does the government earn no money off you? When you don't do a transaction. If you're just holding Microsoft and it just keeps going up, or JP Morgan or Goldman Sachs, it just keeps going up, they can't tax you. They haven't yet started taxing on wealth. It'll come, but it's not happening yet. Okay? Historical verdict. Odds favor another year of upside. Good. But I'm not worried, because if the market falls, like Warren Buffett, I love it. My teeth start itching when the market falls, because I know I've got these good companies and I can buy more of them at a price they've already been at, knowing pretty certainly they're going to return to a price they've been at as well, which was higher. Fantastic. Primary risk is not the destination December the 31st. It's going to be managing the journey of the 14% drawdown. It's going to be me hand holding you when you feel like throwing up and crying, which you shouldn't do, because it means you've taken too much risk if you do feel like that. Okay? You should have been holding more cash, i.e. more certainty, if ever you feel worried. Okay? So S&P 500, rare winning streak. Take a picture of this. We've put it down into one image. Everything I've just told you into one simple image. Okay, this is it. Right? So that's the exact summary. Hope you like those. Sorry I joined late. Will there be a recurring real KP? There will. Not saying anything, Adrian. 56, just a couple of years older than me. Right. Now, Roger, I'll come to the Q&A, the analysts in a second. S&P 500 forecast top firms, what they predict for 2026. Oppenheimer, 18% higher. Was it JP Morgan? No, Morgan Stanley. Morgan Stanley, 16% higher. That's a lot of people telling a lot of wealthy clients, put your money into this. The only people who matter are not the journalists. They don't have any money. Go speak to journalists. The people who matter are the clients of these companies, because they're the ones with the money. Unless I'm missing something. Okay? It's a capitalist system. Capital is all that matters. Not, well, I'm really clever, but I've only got 2 brass coins to rub together. Sorry, you're irrelevant as far as the stock market is concerned. That doesn't mean it's necessarily going to be higher. But like I said, even if it falls, I don't care. My point being, I'm not trying to sell you a fund and saying, oh, please, please buy my fund. We're very positive. Don't know. I have a good night's sleep because I've built the house out of bricks, not out of straw, where I'm hoping for it to go higher. I tell you when I'd be hoping for it to go higher. If I borrowed 10 million from JP Morgan Private Bank, put it into 2 times leverage S&P 500, on the expectation it's going to go up 11%, so I make 22% on my 10 million, i.e. 2.2 million, pay them back 8% interest, 800 grand, pocket 1.5 million before tax, million after, then I'd be hoping it goes up. Because if it fell, I'd end up having to pay them back at the end of the year a lot more. Okay. So I'm not in the hope category. I'm in the I like to sleep easy at night category. Okay. The dogs of the Dow is a theory that if you buy the stocks with the biggest yields in the Dow only has 30 stocks. Okay. If you buy those, you can outperform the Dow. So last year, the Dow went up 13.7. The dogs of the Dow had a 70% gain. What do I mean by yield? What I mean is if you buy $100 of a stock, the dividends you get, the interest you get on your 100 might be 4%. That's your yield, okay? So the ones which give the biggest yield, the biggest dividends, right, are the ones which should outperform the Dow. So the theory goes, and I'm not a follower of the theory, so I'm just giving this as an example, education, information, Nike, United Health, Home Depot, Verizon. If I was speaking British, I'd say Home Depot and Verizon. But they call it Home Depot and Verizon and those. I'm not into that theory. It's a theory. Seems to work now and again. Not one for me, but I thought I'd share it with you because at this time of year, you get a lot of people talking about it. So I thought I'd give you the data. I'm very much about data. Scientific approach. Has the hypothesis been tested by the data And even then, you're only left with probabilities. Like with any theory, it's a probability, never a certainty or guarantee. Bitcoin, let's take a little detour. What's going to happen? Here are the two theories, as ever, two theories sitting on the fence. Citibank think 143,000. Okay, good. Then my small Bitcoin, I've got Bitcoin, Ripple, and Ethereum. I'm not trading them. I'm not gambling on them. So don't ask me for the short term. If you want to know what to buy for the short term, hold cash. For the simple reason, I'm not going to tell you to go and speculate in the short term. That's not what this webinar's for. Okay, ETFs have increased investor access through exchange traded funds. So you've got a lot more people buying them into their through funds as well, because it's easier than going through flipping at Coinbase or something where you've got, well, don't even ask about buying it directly. I hate it. So I prefer either ETFs or, in my case, eToro and, oh God, what's the other one? You have it on your phone. The bank, Revolut, okay? Rather than, I've done it through the traditional route, and it was a pain in the ass trying to remember the codes, the access things, and directly through an exchange. It's not for me. I'm not that geeky. So what's going to happen if it goes below 50,000? In the case of Bitcoin, I'll buy some more. That's it. That's it. Job done. Okay. Everything else is held for the long term. That's it. End of story. If you wanted to trade it, good luck to you. This is not the webinar for it. 2026, and I'd only ever have 5% max of my total investable portfolio in it anyway, because it's pension stuff. I'm not here to mess things up. I'm at an age where, thank you, I'm not here to gamble. I've never gambled anyway. I mean, I think the most I did at Vegas on the blackjack table was $100, and I think I made it last about an hour. I'm Gujarati as well. 2026 investors playbook, traps to avoid in 2026, financial news. Just be careful. Picking individual stocks, thinking that you've got to get them all right. No, think portfolio level, else you're going to panic. All right? Panic and boredom are going to be your two worst enemies, as they are every single year. I'm going to keep saying this. If you do not think portfolio level and think individual stock level, you're going to mess it up. And I'll give you a classic example of how. If you've got, just imagine you've only got two companies. And let's say I had a time machine to tell you that both these companies are going to go up 20% in the next year. Okay, just make that assumption. But one of them goes up and down like this and ends up 20%. The other one does the inverse. When the first one's up, then the second one's down, and vice versa. They both generate 20% over the year, but one goes up like a sine wave, the other one like a cosine wave. Okay, so inversely. If you hold both investments, you of course make 20%. And the ups and downs of one cancels the downs of the other, and you get a flat line going up 20%. In other words, two risky assets, because they both went up and down, combined, removed all your risk, you got your 20%. If you remove one of those when it was down, because you thought, oh shit, this is down, I better reduce my risk, you're left with just one volatile entity. You've actually increased the risk of what you're left with, or increased the volatility of what you're left with. Counterintuitive. Harry Markowitz, got a Nobel Prize in economics for showing what I've just explained to you. And I could not, if you left me on a desert island for 1 billion years, I would not invent the microwave or come up with that theory. But he got the Nobel Prize, and deservedly so. Okay? So when you start looking at individual single stocks and you panic and then sell, what's worse is you're increasing the risk of what you've left behind, and you didn't even realize it. And it is counterintuitive, and that's why I've given you a two-stock example, because if I gave you a multi-dimensional example, my brain wouldn't even get around it. It'd be like, what? How? But with two, I think it's easier to understand. I've just taught you something which a Nobel Prize-winning economist would teach you, and it's so important for wealth creation to understand that. And when we create portfolios for clients, we're looking for that, inverse correlation. We're looking for non-correlation as much as possible, and that's how wealth is created over the long term. All right. Anyway, rule number 2: only own what you'd buy more of if it drops. For us, that necessarily means companies which are undervalued, growing, good, strong cash flows. If you're not willing to buy more of it when it drops, you're trading, you're speculating, you're going to panic. You're going to make your life very difficult. And good luck to you. You might still make money if you make your life difficult, but chances are you won't. How do we know this? The academic research shows it. You're going to F it up. Eugene Fehmer, Nobel Prize in Economics for that. Daniel Kahneman, same, showed it in different ways. Richard Thaler, Nobel Prize in Economics for showing it. And I've written about all of them in my Financial Times columns and my books because they were freaking amazing, the research they did. I only do what the best brains in the world have done, and I only buy the best companies in the world. I don't invent anything. I don't originate anything. Okay? Because I'm not a Nobel Prize winner. I'm not good enough to be that, and I'm not good enough to be the CEO of a company. So I take their knowledge and apply it to those companies. That's it. It's a pretty easy life. It's the Warren Buffett life. Okay? I don't try and be the guy. Market action. There's only three things that can happen. Path A, B, or C. Path A goes upwards. Action plan, do nothing. Path B, short, sharp dip. Action plan, probably do nothing. Maybe exit, but the danger is you buy back more expensive because it's a V-shaped recovery. Path C, again, either do nothing, buy more, or exit in the hope of buying more back cheaper, but it might be a path B. And you don't know whether it's C or B until you look in the rearview mirror, in which case you might buy back more expensive. Very simple. Now you've got an action plan for all three. Based on your risk appetite, you'll decide which one of those to do. You don't have a time machine. You'll only know in hindsight which was the best thing to do. So to give you an example, in 2022, when the market had a prolonged fall, i.e. path C, the best thing to do was to exit and buy back cheaper. In 2025, when the market in February to April had a V-shaped recovery, or in COVID, the best thing to do was just sit through it. But you only knew that in hindsight. So based on your risk appetite, you either did nothing, because your risk appetite was, hey, I'll do nothing, I'll wait, and bought more, or, which is more a Warren Buffett thing, or you were a bit more risk averse, you said, I think I'll get out, but I might have to buy back more expensive later, which is what happened if you did that during COVID, or if you did it this year. Or path C, you exited, and guess what? It fell and you bought back cheaper and you made out like a bandit, more than the person who did nothing. The optimal route we'll never know ahead of time. It'll be guesswork. So you've got to choose it to your risk appetite. Me, I'm usually get out and buy back later, possibly more expensive, maybe cheaper, rather than, and that's in the case of path B, once every 7 years. In the case of path C, once every 18 months. Sorry, path C, once every 7 years, path B, once every 18 months. Okay? But don't worry, I'll be doing these webinars all the time, God willing, throughout the year. This is, take a picture of this, take it to the printers, put it on your wall. I might start selling these for £1 or something, you know, on you, or just for postage costs. You can put it on your wall, we'll print them out for you. And I'll sign them. Sign them and send them out to you and charge you whatever it is. What is postage nowadays? First class postage, it's really expensive actually. I think it's like £1 or something stupid. Calm Investors Playbook, disciplined approach. Avoid what I've just told you. Okay, don't chase the winners. Buying stocks just because they rose dramatically is unreliable because it's not tested. Avoid the fund managers. They're going to be out marketing like mental because they're going to claim credit for the rises in the markets over the last 3 years. They know they've got to market and get your money in now. Okay, so just watch out because we know fund managers underperform. And I'll show you what a better way of beating the S&P 500 is in just 1 second. All right? Put another way, these are the only three things that can happen, A, B, or C. This is just the other image put in this way. Okay, there are only three things that can happen. It keeps going up, sharp fall, longer fall. That's it. And if you've got a strategy for each, you sleep easy at night. You're not sure and you're going to wake up in cold sweats, print that out, put it next to your bed. Each time you wake up in the middle, like, oh, shit, what's going to happen? You go, oh, it's okay, I've got a plan. All right. S&P 500 1 year is this, okay, over the past year. Now, let me give you some lessons with hard numbers rather than just generic wisdom of the market. At the start of last year, I had absolutely zero idea, if you asked me, and you know this is the truth, because you could watch my videos again, I would have had no idea that my Goldman Sachs holding is going to go up more than my NVIDIA one. In fact, I would have said to you, if you're going to put a gun to my head and make me choose Goldman Sachs or NVIDIA, NVIDIA is the one that's going to go up. You said your life depends on it, Alpesh. I still would have said, I think NVIDIA will outperform Goldman Sachs. It didn't. Goldman Sachs went up more. If you said to me, between Microsoft and Google, will there be a 10-fold difference, not tenfold, 6-fold difference in their returns over a year, I would have said, no, don't be stupid. It can't be a sixfold. What are you saying? Google's going to go up 60% and Microsoft only 10 or 11? Yeah. And Amazon will only be up 2. I would have said you're insane. My point being, when I have a portfolio, I do not know individual stock performances. I got somebody else today message me again. I feel like slapping him. He goes, oh, I'm going to leave out Amazon. What do you think? And I said, well, I didn't even know last year it was going to go up only 2%. It was in my portfolio, but my portfolio is up nicely. Would have been up bloody more if all I had was Google, obviously. But it was up very nicely, thank you very much, because the market went up anyway. Not because I'm some kind of genius. My job is not to F it up. My job is not to have too many stocks which will go down. And every single year since before he became the world's richest man, Warren Buffett had stocks which didn't go up. Every year in his portfolio, there were some stocks that didn't go up, and he still became the world's richest man. I'm sorry, if you want to be better and try and be richer than the world's richest man, sorry, this is the wrong webinar for you. Okay. Those people who look at stock level as opposed to portfolio kick themselves because they go, oh, everything didn't go right. And I'm like, yeah, the world's richest man doesn't even think like that. Who the hell do you think you are? Okay, so, and again, I will tell you the truth. I did not realize that Microsoft would only go up that much and Alphabet would go up 60. Because if I knew that this time last year, go on my YouTube videos, I would have said to you this time last year, hey guys, buy Alphabet and nothing else. Okay, we'll have a look at some of those in a second. This is the S&P 500 over the past year. Now, the fact that I happen to own those in one of the model portfolios that we have, and various family members have different models in there, does not mean they're going to go up again, because there were some which didn't go up somewhere down here. The fact that tech companies did, or semiconductor companies outperform, doesn't mean this year they will. It might be that, I don't know, healthcare companies do, oh, there we go, there's healthcare, do particularly well. Don't read too much into all of these bubbles, okay? World over the past year. Now, again, you get people saying, well, aren't you being American-centric? No, I'm not. I'm being global-centric. And if you find me another planet to invest in, I'm happy to do it. But this is what we're restricted to, because each one of these companies, including these Chinese ones, and by the way, if I wanted exposure to China, Alibaba is the way I would do it. It's a bit too volatile for me. Or Pinduoduo, I can never pronounce it, PDD. Okay. These are all listed in America. So why am I buying them if they're listed in America? Well, because it's bloody easier to put it in a SIP and ISA than say, can I have a Shanghai B stock? I don't think you can put them in British. I don't think you can buy direct Chinese stocks in British SIPs and ISAs, but you can American stocks. I might be wrong. I don't think you can. Okay. So I've got a lot of the world covered. And if these don't bubble to the top, 200 out of my 10,000 stocks, and out of the 200, I picked 20 to 40 companies on a tiebreaker. Okay. And the tiebreaker might be if I like the sound of the name. Because once it's a tiebreaker, it's a freaking tiebreaker. If I could narrow it down for any further, I'd just have one stock. I've already got the world covered anyway. It's been bubbled through, including British companies. If people go, why didn't you have more British companies? Well, if they don't make the cut, they don't make the cut. I'm not going to be racist and say, well, I only want British companies. Don't want any of those bloody South Africans in there, even though they might do well. Because if they don't get that, they have to get their own merit into my pension. It just so happens the bloody Americans flood the market with 8,000 equities and everybody. I mean, look at Britain, FTSE 100. There's 100 companies. That's it. It's the biggest. You might as well, what about the 250? Yeah, but they're getting really small once you get into that, and therefore more volatile oftentimes. This is wrong. We've already, since December 29th, we've got to 6,500,000. We put on 500,000 in under a week. This is accelerating now on YouTube. If you've not been to my YouTube channel, by the way, there's a lot more to come. I don't want this to sound like the end. If you've not been to my YouTube channel, might I suggest you do it, please? Okay. It's good because there's a whole load of videos on fixing your pension, including why St. James's Place is terrible, other wealth, sacking your IFA and why you might want to do it. Also pension reviews with popular pension funds, including Scottish Widows, Standard Life, a whole bunch of others. It's all in there. And they're updated, well, that's 6 hours ago. So there you go. Pretty flipping regularly as well, which I love because I love Not the sound of my own voice, but I love to explain and teach things to people. So do have a look at that. Now, let's go into the markets a bit more. So let's start the webinar. This is usually the first slide I have. If you're looking at momentum, and I'm not, just so you know, everything that I teach on investing is not momentum based. But if you're looking at momentum, these are the momentum ones, not the ones which are crossed out. There's a few here are crossed out, so ignore the crossed out. I told my team to put it together. Okay, you can take a picture and look at them yourself later on. This isn't a momentum one. So I know some of you like your tip sheets. You like your sort of seeking alpha type, the breathless. So I think this is going to go up. So if somebody put a gun to my head and said, which ones over the next 3 to 4 months? And if you wanted to trade on your own head, be it. But the angles we look for any of these are, realistically, can you get 40% to the upside if it continues at a trend that it's historically hit before? Can the stop loss be at 20%, i.e. 2 to 1 reward to risk ratio, such that that is below a recent support, so it really shouldn't go there. And if it does hit the stop loss, don't put more than 1% of your total capital risk losing if it goes to that stop loss. There's your money management rule, there's your risk management rule. But you can't just pick one of them. You got to pick them all. 50%, well, actually 60% of them will go up 40%, 40% of them will drop 20%. You do the math, so that's your annual return. Boom. Okay, that's it. If they go up 40, get the hell out. If they drop 20, get the hell out. That's it. That's it. Not for me, but I know some of you like all of that. It's not what we teach on the program, but people like a bit of momentum. They retail clients, they like to blow their heads off. What can I tell you? This is how we did. We've got the numbers now for 2025. So I said to you, how do you beat the S&P? Well, it's very simple. By the way, the simplest thing you can do is just have the S&P index. If you've got the 2 times leverage, which I guess, look, I could have saved myself a lot of time over the last 26 years and just had that and nothing else. But its returns are in brackets. The brackets don't mean negative. So the 2 times leverage part beats the S&P underlying. There you go. Simple. You've just beaten the S&P. Well done. All the people who go, yeah, but with all this, can you beat the S&P? Yeah, it's really simple. 2 times average S&P. There you go. What's your problem? And if you don't want 2 times average, have 25% in cash and 75% in 2 times average. You've overall reduced it slightly and you've got more certainty. You're still going to beat the S&P. Simple, done, job done, and there are your numbers. 27, 44, 47, minus 38, that'll give you a heart attack. 60, 21, 66, and if you're working at minus 60, 44, if you're trying to work out what the annualized return is, it's better than the underlying, despite the big negative falls, okay? So there you go. There you go, pumpkin, well done. These are just some of the client portfolios. We've not cherry-picked these are just some of the ones, and these are the various returns. The reason some are lower returns, if you take that one at 36 and this at 18, why has that got half of that? Well, because it was engineered to have lower drawdown in between, because the client wanted less drawdown, can't take the heart attack that the higher volatility ones. So, and what's going to happen next year? I would say with each of these, they will generate somewhere between their lowest and best year. That's the only thing I can say. So I'll give you an example. What will happen with this particular portfolio, which we've got one member of the family in, younger member, it'll go somewhere between 0 to 56% in the year. Oh, okay. Oh, bloody useful. Well, sorry. That's all I can say. I ain't got a crystal ball. We'll be somewhere between that. Similarly, what will happen to your quality 5, which you keep talking about, Meta, Microsoft, Apple, Amazon, Alphabet? As people know, I talk about it all the time. I've got it in my portfolio. My son's got 2 times leverage on those. What's going to happen? Oh, where is it? But he's only 7, turning 8 next month. What's going to happen? Well, that's going to go somewhere between, if we were to hold it without exiting on a daddy bear, and let's say we had a daddy bear this year, somewhere between down 41% to up 88. You wouldn't just have 5 stocks in a portfolio, obviously, but this is to give the extreme example. What will happen with the AI picks? Model portfolio, somewhere between -5 and up 125, I would have thought. Which one? I don't know, but that's the best I can say to you. Okay, so the other thing, please don't trust these fund managers. Don't take my word for it. Nobel Prize winner Eugene Famer, don't trust them. Please don't trust them. I mean, they won't steal your money. They'll just make you lose it. That's that. This is from the Financial Times. Okay, that's from the Financial Times. Mikhail, nothing's going on with Pittsburgh. What do you want to know? We've still got the daily updates on Telegram. Are you on it? You should get the daily updates. We're on version 4 of the indicator. The most powerful action an investor can take is nothing. If you've got good quality companies, then you want to sit back. If you're with these fund managers, you better do something, because they're going to depreciate your wealth. Why? Because the fund management industry is built upon having the most amount of assets, because they get fees based on the amount of assets that you own. So if they've got more assets, they get more fees. If they've got more assets, they've got to divide those funds into UK, Southeast Asia, whatever, which means they're picking from a very small gene pool. We pick from a gene pool like Warren Buffett of all 10,000 equities. They pick from just the UK ones. They're picking from 100 companies. Well, who do you think is going to win? Somebody who filters down from 10,000 to the best 200 in the world? Or somebody who says, well, I've got 100 companies. I just hope those ones are going to be the best. So that's the problem. Stuart, please answer that slide stated, don't buy last year's winners, but Microsoft winners for about 20 years and they're still... What I'm saying is you don't just buy it just because it was last year's winner. That's not a hypothesis I've tested. Just buy last year's winner. It's not saying don't buy last year's winner. It's saying don't buy it just because it was last year's winner. You've got to have more reason for it, like value growth, income, cash flow. So to give you an example, Microsoft, Amazon, and all the rest of them ticked our boxes on this. We didn't buy it because it was last year's winner. We bought it because it ticked these boxes. So hopefully that's clearer now. It wasn't, if it's last year's winner, don't buy it. That'd be stupid. Why would you have that rule? Nobody's tested. Well, I haven't tested that hypothesis. I don't think that would work. Not to buy something just because it was a winner last year. Narratives are a trap. Price is the only truth. Okay, so be aware of all these. You're going to get these narratives. Recession looms, AI bubble about to burst, war in Europe shakes markets, global debt crisis, interest rates panic. You're going to get those headlines. I've already predicted it. By the end of the year, when I show you this again, you're going to go, shit, Alpesh, how did you know? It's like you had a time machine in a parallel universe. Every single one of these headlines is going to come up this year. I've been into the future. I've seen it. Trust me, it's going to come up and you're going to panic. Don't. The problems we're trying to solve are these, as you will know. Okay, it's been an hour. I've got to cut it off soon. It's supposed to be 45 minutes. Poor performing fund managers, how do we solve that? We make sure you've got all 10,000 stocks we go through, and I'll go through some of the stocks in a second that I've got. Fund managers being crap at their job because they can pick from a narrow gene pool, but they get paid high fees to lie to you that that's going to work. Eugene Fama, Nobel Prize winner, proved to them that they're lying. And then you got the St. James's Place, where 90% of our clients come from St. James's Place. Basically, people who are miserable with St. James's Place, they join my program. And then we want to share what the rich and powerful have. And a lot of people saying, well, I don't know what to do, so I'll just hold cash, which is terrible as well. But David, I'll have a look at that again. Stuart, is it 25% drop from the price you buy a stock? As I didn't understand when you say from its high to sell it. Sorry, Stuart, I don't understand the question. Could you write it out really slowly for the end Q&A? I don't understand what you mean. No, it's not 25% drop to sell. Were you talking about the trading? Just email me and I'll answer it again if you didn't get it. That was for the momentum ones I think you're talking about. That's maybe it's confused people. The momentum stuff is just for people who want to do momentum quick stuff. I don't recommend it. Maybe it was too complicated. I can email you that, but that's trading. And I don't recommend you do it anyway. Maybe I'll take those slides out on the momentum, where I put those ticker symbols. Maybe it's confused people. How we do it, very simple. You filter down, you create a portfolio. The biggest thing in a portfolio to look for is not how it's done in the past, because there's no guarantee of the future. It's not what its historical returns have been, because we're not curve fitting to the past. We're looking at how its balance sheet, profit and loss is doing today. But the reason we look at how it's done recently is not because we're seeing, it's done 30% per annum. We halve that anyway and say, well, if it does half as well, do we still double our money in 5 years? Yes. Okay, tick. So 1 million becomes 2 million in 5 years, becomes 4 million in 10. 1 million becomes 4 million in 10. Fine. At half that rate. Okay. That's not the reason we do it. This is the reason. So we know should get a drawdown about 10%, not to panic. Individual stocks might drop 75% in that. But the portfolio, 10%, don't worry, it's going to happen. That's why we do it, to inoculate ourselves, vaccinate ourselves against falls. Okay? Goldman Sachs metric, cash is king. This is an important metric. I keep talking about cash return on capital invested. Goldman Sachs found companies in the top 25% by cash return on capital invested generate as a basket 30% on average per annum. Not every company in the basket. This is where people get confused. They think, oh, every stock will do that. No, and not guaranteed every year. Some years more, some years less. Okay? We throw it all in, value, growth, income, cash flow, Sortino, have the stocks, hold them for 12 months and then rebalance, hold for another 12 months, rebalance, maybe move to a different model even after 3 years if you think the market's changed. We're not actually that bothered whether the money doubles in 5 years. This is time it takes to double your money, whether it happens in 5 years or in 3.8. Obviously, I'd love a 40% return, but that's out of my hands. That's the market. And the market does really well. It does really well. I don't sweat it because it's out of my hands. Why would I worry about, that old saying, God give me the strength to, survive those things which I can't control, or endure the things I can't control, and tolerate the things I can, whatever, improve the things I can, and have the wisdom to know the difference. I don't sweat what the market's going to deliver because I don't know what it's going to deliver. And once you have that mindset, which is very much a Warren Buffett mindset, and because he confirmed that view, which I came to independently of him, as many people have, I thought, oh, must be on the right track because the great man thinks it as well. But I know I've got the odds in my favor because the average positive return is 32% per annum over every rolling 2-year period. And that happens 88.5% of the time. Another reason why I don't panic with narratives, because the statistics are on my side. And that's the point. And if we get a good year like this, I can't take credit for it, although I'll take credit for it. It was the market, obviously. And if I said to you, oh, aren't I clever? We did this return. You'd say to me, no, you didn't, mate. JP Morgan did that return. You didn't do that return, mate. And I'd say, yeah, actually, you're right. Alphabet got 60%, mate. You didn't get that. Yeah, you're right. It wasn't me. Got a bunch of reviews up there as well. For those who don't know how open SIPs and ISAs, it could be Barclays, it could be Interactive Brokers, Interactive Investors, whatever it is. You go there. You need that. You open an account. It's as simple as opening a bank account. Just beware of these name recognition brands like Scottish Mortgage who are going to kill you. They're going to drag you lower and lower. They lost 50% of people's money. And I like to remind people of that because people arrogantly assume that fund managers know everything. Please do also, there's more to come. And we've got Q&A. Do follow me on LinkedIn where I'm a top voice now, apparently. 29,000 followers. I've got 500,000 on TikTok, but follow me on LinkedIn because I do a lot of articles on there as well, which are more deep dives into a variety of topics on there. Okay. And a lot of followers and connections on there as well. Okay. So do please make sure you do that. We're going to talk a bit more about something. One of the things I like to point out to people is how much I don't actually care what analysts think. If you look at something like Microsoft, okay, and the return potential is 31% if the company hits the average analyst forecast for it. The average analyst forecast is 622, some saying 730, some saying 472. That'd be a 31% return. Great. But when we've looked at those hypotheses, they don't tend to work out well. That's why we don't just care what analysts say. You're going to read a lot about analysts and what those are, but I thought I'd just share that with you. We own it because value, growth, income, cash flow, Sortino, Alpha, we've really done our due diligence and hard work on it. That's why we own it. As you know, if any of you want to join the program, do the Q&A now. I want to get, and I was thinking about this before the program as well, we've got a team now around the world. I want to get maybe 500. It was originally going to be about 350, but I think we're going to have 500 charter members. The first people who will never be charged a subscription fee or management fee or any other fee other than just one-off for lifetime access and lifetime access to me. Then I want to get venture capital investment in, get teachers around the world for other people going forward, expand it, maybe float the whole thing as an alternative asset management company, a challenger asset management company. Well, we don't manage your money. but we give you the data and the education for you to manage it instead. So you cut out the middleman, don't have the fees. And we think that is a bloody better way to go. So if you do want to do that and be part of the program, I'm going to do a Q&A in a session, then do, and we lifetime access with me with all the data, and we evaluate the profile and the portfolio, and then create a model portfolio for each person. So each person's model portfolio is bespoke to them, and then they handle and deploy it with whichever broker they wish. And sort of like a private bank approach, but without the fees, if you see what I mean. And that's where you go. We restrict it to just 10 people at a time because I onboard them personally. So we've now got an AI team, a data analytics team, presentation team, graphics team. It's phenomenal. So we're able to do more and more, including creating those model portfolios for people as well, which previously was somewhat limited what we could do, only because we didn't expand the team, and we've now expanded more and more. So I'm going to answer your questions on that and answer this. Oh, I'm going to show you how we did last year. We're going to update the website this week, actually. We'll be able to do. Let me just show you how we, for 2025. So I've shown you some of the models, but the numbers, Paresh has just crunched them, have come in very nicely for 2025. But if you want to see previous years, like 2024, we beat 2024. I won't give you the exact number and all the rest of it. We're going to update the website first, hopefully this week. 2024 was 41. It beat even that, which I wouldn't have known by the start of the year. I actually thought 2025 might not be great, only because there'd been 2 great years and Trump was doing tariffs. So who the hell knew? Although I should say some of that performance was even better for some of the leverage holdings, obviously, but I don't recommend you do leverage, and let's not count that. 2023 was good. However, 2022 was 0 because the markets had fallen and we had to hold cash. And I'll remind people exactly how we do that and why on the rare occurrences where cash has to be held, we show people this. This is the educational material, which none of my clients ever bother reading, I don't think, because we can see at the back end. They don't have to do the education because essentially all they have to do is take the data, get a model portfolio which suits their drawdowns. We go through it and say, yeah, that actually fits, or it doesn't. What the hell are you thinking? And then they run with it. Okay. So it was a good year, not because we were clever, but because the markets were good. That's why. Let's be absolutely clear. I'm not clever enough to have created a time machine at all. I'm going to answer some questions now as well. Okay, and I'm also going to share some files with you guys because I want to share the book, The Investing Unplugged. It's one of my international best-selling books, published by Palgrave Macmillan. So I'm going to share that with you as well. Okay, and I want to answer the questions and make sure what have we got on the chat. Okay, do you have a view on silver? Looks like a bit of a throw. Well, I own gold, that's it, because of the tax-free. Beyond silver, the best thing to do with exchange-traded funds and a commodity like that is with any exchange-traded fund, let's see if I can pull it up, whether it's gold or silver, ETF, funds. Okay, silver, let's take silver. On this is I just have the MACD rule. If the monthly MACD is falling, I'd want to be taking the position off. If it becomes a daddy bear, I fall steeply, then get out completely. And if it's rising, then I'd be holding. It's as simple as that. At the moment it's rising, so I'd be continuing to hold. It's as simple as that, okay? That rule is a lot simpler. If you're not familiar with it, here it is. It's explained on campaignforamillion.com under the articles that I've written. Okay, and we go through it, and there's a whole load of other articles there, and we go through that exact point about the bears. Here we go. There it is. There's the bears. Okay, and the resources here, what you do on each cycle. So it just explains it, and that's what I do with silver. It's as simple as that. But then again, I don't trade silver. I'd be doing that if I was trading it. If I'm not trading it and I'm holding it forever like Bitcoin, then I don't even follow any of this. You just hold it. It's just there for Bitcoin. Stuart, I read off all your free material, but I can't afford to pay for the cost. That's fine. Is there a one-off mini fee? Yeah, the mini fee is 0. Go to investing-champions.com. Investing-champions.com. Okay. that's your mini fee. It's completely zero. We have two fees, the fee and zero. I can't get lower than zero. Okay. And investing-champions.com. If you were 25, would you rent or get a mortgage? George, it's such a good question. I might answer that in a proper detailed thing. I'm starting to think now I would rent because I don't know, George. Let me think about it. It's a common one. You see, when I was 25, I bought my first property in St. John's Wood at 27. And it doubled because at that time, when I was that young, it did, because they did, and then I bought the next one on Hamilton Terrace. And that's when the market stopped doubling every 5 years. And then it just after 5 years went nowhere. And if you don't know Hamilton Terrace in St. John's Wood, I literally lived opposite Kavi Alamutai, who was the highest paid employee in the world, hedge fund manager, and diagonally opposite, friend of mine, James Caan, not the actor, the one off Dragon's Den. That's Hamilton Terrace. And after 5 years, the price was flat. Can you believe it? That's when it happened. Bought it in 2003. No, 2002. So 3 years, sorry. 2002. And in 2005, it was still flat after 3 years. That's unusual. So I don't know, George. I just don't know. I'll have to look into that. SpaceX is still a private company. I've looked through NASDAQ private markets to see if I can get my hands on some stock. Sometimes the private banks offer you some stock. But it's a private company, SpaceX. They should do an IPO. In this market, it'd be stupid not to. In fact, read my lips, he's going to do an IPO. For sure. Elon Musk will do an IPO. Okay. What's the next chat? Cars. I gave one car to an uncle, one car to my dad, one car to my wife. I now use an electric bike because I live in London, and everywhere around me are 20-mile-per-hour speed limits. And I've now already got 6 points. My wife got 6 within, basically, as soon as they put those 12 mile. And without describing what kind of car I gave her, let's just say it's German and incredibly fast. And I think it's going to stall if you go at 20. It's freaking hard. You can't even put the speed limiter at 20. Anything below 20 won't allow you to. So you've got to go to 21, but the speed limiter. So it's pointless in London owning a bloody car. But having access to one's useful. I mean, flipping heck, I can get a Mercedes Uber to drive me around, chauffeur driven, and it's still cheaper than owning a bloody car. So, in Cornwall, you need a car. In Cornwall, you need a car, Stuart. You need a car in Cornwall. It's true. Raj, if a stock, never a truer word has been said on my webinar, Stuart, than what you've just said. It's the wisdom of ages. I'm going to keep that on my wall. In Cornwall, you need a car. Raj, if a stock has a drop that's larger than it previously has before, would you take it off your list? No. That in itself is not reason enough to take it off, because if there is still valuation, revenue growth, other reasons, it's very difficult to know, which is why whether you've got 40 stocks, i.e. 2.5% roughly in each one, in a way, you don't care if it's the next BlackBerry and it's going to stay low. What you're trying to do is optimize for the stock, not the portfolio level. You are going to get some of those. The moment you start worrying about it means you're a bad investor to begin with. So slap yourself and stop being a bad investor and worrying about each individual stock. You're going to get those. Have you read how many times the world's richest man at the time, Warren Buffett, had said, oh no, that stock went down this year. And you want to try and outperform him. So no, Raj, you don't. It's half of the course. It's going to happen. The fact that you've allowed for it to happen within your system and process means you've got a bloody good system not to worry about it. The moment you start worrying about it means you're a perfectionist and you've got a problem if you're an investor doing that. Warren Buffett said, if you can't handle a stock dropping 50%, you have no business being an investor. 3 times in his career, his whole company portfolio, in other words, dropped 50%. And yet he became the world's richest man. I'm happy being the world's richest man, assuming that world is Earth and not Mars, in which case it might be all right if it's Mars. Any other questions? Charlie Munger hated diversification. Absolutely right. Well, Charlie Munger's not the only one who hates diversification. Let me show you something, guys. I can't. Oh, wait a minute. I might be able to. Yeah, I can. Give me a second. I'm going to show you something. Warren Buffett hates it. Warren Buffett famously said, put all your eggs in one basket, watch the basket. I hate diversification. I don't have diversification. I have asset concentration. I actually have more concentration than Warren Buffett. I have 20 to 40 stocks. He has even more than I do. But then again, he's got billions. There you go. Yeah, I'll show you something. There's your concentration. Buffett, Apple, 14%. Okay. Sorry, 23% in Apple. 19% of his portfolio is American Express, 11% is Bank of America, 10%. So after his first 1, 2, 3, 4, 5 holdings, everything he's got less than 5% in. Same with Bill Gates, Goldman Sachs. It just so happens I own everything Goldman Sachs have got with the exception of Tesla. Liam, on a workplace pension where you can't hold cash, I know, what would be the alternative? Putting into something fixed income such as bond gilt? I've done a detailed, that warrants a detailed response. I've done an article. It's completely free on campaignforamillion.com because a lot of people have been asking me very similar thing. And there's a lot of bad information out there. So what we did is a very, very detailed article on bonds and there you go, bond funds or fixed deposits. And if you look at that, okay, it'll answer that question. And it warrants a degree of detail, and that's why this is the answer. Okay, and I've tried to make it as simple as possible, but it shows you yes, no, and what you should do, or what you could do. Okay, but it also answers you why some of the things you thought you should do, like a bond fund, would be fine. It has to be short-term treasuries, really near term to expiry. Otherwise, you've got interest rate risk and yield risk. And you're not getting the returns you think you're getting, which is what happened when Liz Truss was prime minister and a whole load of pensioners saw their portfolios decline by a significant amount of money. Okay, Alpesh, can I please clarify, is 124 discounted price or full price? No, 24, let me make that clear. Oh, I'll do better than that. Let me just show you so you can clarify. If you go to alpeshpatel.com/shares2, there it is. It's one-off payment is that, including VAT. If you've got a company, you get that back. Financial education to the directors, the company potentially get that back. If you're outside the UK, you don't pay VAT anyway. Or it's 24 installments of that, including VAT, depending on whether if you're outside the UK, there is no VAT. Obviously, we only punish people in Britain with value-added tax. We don't punish people abroad with value-added tax. Unlike Trump, who punishes people abroad and domestically with tax. Now, there you go. Okay, so it's that number times 24. Hopefully, sorry if that wasn't clear. It's that times 24. Maybe it's not clear. I'll clarify that in future. Times 24. And it explains it if you go there. Okay, so very simple. Let's see, what else have we got on the questions? I should also, I guess, show you some of the headlines in case anybody's worried about headlines and what's going on at the moment. The Maduro thing is completely irrelevant. Venezuela is irrelevant to the stock market. Well, I thought it was irrelevant to the downside. Bloody hell, it's very relevant to the upside. The market's taken that as a massive plus, which is fascinating that it has. Stuart, in the mid-1990s, Buffett said that retail can beat the market because they own little cash and seek small caps where big funds can't buy into. Yeah, that was in the mid-1990s. I think small caps were good. He also said, if you don't know what you're doing, just buy index trackers. Personally, I shouldn't say this, but personally, 2 times leverage, better. But don't do leverage because it's irresponsible for me to ever suggest leverage on an ETF, on a pension. But yeah, he's right, what he said. Basically, you've got more choice than funds have because you've got more of them. What he's basically saying is you're not picking from a narrow gene pool of just large companies. And in the 1990s, absolutely, still the case. Could I? But this from there. Yeah, Chaz. No, absolutely. We have a lot of people who do exactly that, Chaz. So you can. from your limited company, so it's not a problem. And we send a contract and a VAT invoice and all the rest of it to you as well. Sean, I'm planning for a daddy bear. Buy 2 times over S&P that also 2% do very good plan. No, Sean, sorry, that's not something I should answer that quickly. I need to think that through, and I wouldn't be. You're trading, basically, is what you're saying, and you're going to get whipsawed. What I would personally do with my 2 times average S&P is, when there's a mummy bear, i.e. the monthly MACD is falling, I will start, and I'm just going to put it up for you guys. I would start taking some money off the table. Okay, I'm not going to look at percentages, and let's just have a look at that. Let's just. Oh, by the way, this is the emerging market MSCI, a little bit overbought. Massive run up this year, so just be careful. That's what I mean by mummy bear, the green line falling on the monthly MACD. Let's go to the S&P 500. There we go. Okay, so similarly for me, when it's this, I'll start taking a bit of money off the table when it's falling like that, in fear of it doing that. And when it's a daddy bear, it crosses over, I'll probably get out of all of it, especially on the leverage, I'll do another one of these very soon, actually, because I think this week, the first week, everyone's getting into it. I might even do it as recently as tomorrow, where I'll cover the market more, like this, and Microsoft, Apple, Amazon, Alphabet, those kind of stocks. In fact, I think I will probably do a webinar again tomorrow. But with that, it'll be different to this one. I'm not going to repeat the same stuff because you've seen this. So I'll do the individual stocks where I'll go through this. So, that's very much up. If you look and want to understand, well, what the hell just happened with Alphabet? Oops. Over the past year, and what's going, look, it's still doing that. It's still there, which is unusual for it to keep going higher. Okay. Because normally when you get this, you get the price dipping back, but it hasn't. And if the indices do what Alphabet's just done, then you're really looking at an incredible year. But I don't know. It might pull back as it did here, in which case we'll get out and buy back cheaper. Why? Because I don't want to sit on a 42% loss. How will I decide? Well, when it crosses over there, I'll do a webinar, I'll make a decision, I'll let you know. At that time, actually, your program would be relevant for someone who is a US resident too. Oh yeah, we've got 20% of our clients are American as well. With us, but yeah, Anjali, we've got a whole load of people who are both. Chaz, S&P, does that show overbought? S&P, yes, it did. I can go back to it, Chaz. I can go back to it. Here we go. That's overbought. The problem has been, now here's the thing I'm going to tell you about overbought and what the problem's been, is increasingly, I'll give you an example with NVIDIA, okay, and why none of this guarantees something. Look at NVIDIA when it was here, okay, it was overbought. And those who've been watching my webinars will remember this period where I said to people, well, it's overbought, it might fall, but I've got no reason to exit yet because it wasn't a daddy bear. And if you remember, I remember saying, from my tone, you would have worked out, I didn't expect it to keep going up. I just said I didn't have a reason to sell. And so it kept going up. And I thought, oh, okay, I'll take that. I'm surprised, but and then it kept doing this. Now, be very careful what I've just said. I didn't foresee it was going to go up. I could lie to you and just say I'm so incredibly clever with all my certificates. I always foresee the future. No, that'd be bullshit. It'd be lying and it'd be contradictory to what all the Nobel Prize winners tell you and Warren Buffett tells you, that people can't see the bloody future. What I knew was not to sell because we didn't have a daddy bear. Daddy bear being the green crosses, the short-term prices cross below the long-term. Okay, green below blue. And pattern recognition generally means don't hang around when that happens anyway. Not guaranteed to, but generally don't. It just kept going up. And I thought, oh. And if you remember those, so if any of you remember watching that and remember those videos, and they're on YouTube, so you can go back and look at it. And then it kept going. I thought, oh, okay, don't I feel smart? That's all that happened. It's all that can happen. Now, if this falls again, so when this rises, if this happens with the index at the moment, we might get some blowout here, as happened then. I in no way, now you might say, well, you should have bloody expected NVIDIA to go up, you idiot, because it was obvious it's going to go up 339% in 2 years because of AI. Yeah, in hindsight, but at the time when you're sitting through it, Nothing's ever obvious when trust me, nothing's ever obvious with the stock market. And anybody who tells you it is lying. Because without a time machine, nothing's bloody obvious. Anybody who tells you otherwise is being overconfident. If they're being overconfident, Daniel Kahneman, the Nobel Prize winner, will tell you they're going to lose a lot of money and they're an idiot and run a million miles from them. Okay? Just being honest with you. We just held on because we didn't have a reason to sell. You can only buy, hold, or sell. Now, if we were that, because obviously the next question would be, if I said to you, oh no, we saw that going up, so we thought so, then the next obvious question you'd ask me is, well, wait a minute, Sunshine, why didn't you buy 3 times leverage and sell everything else? And I'd say, let me make an excuse. And you'd call bullshit. We held on to it because there was no reason to sell, because it kept generating profits. It's all, we can only see 10 meters ahead. We can't see 10 billion years ahead. Okay? Can you recommend a free charting tool? Yahoo is good. I think you can get on TrendSpider, you get quite a bit for free. Yahoo Finance has a free charting tool, which is pretty good. I think Google Finance has a good one, which is free. This is how Yahoo and Google destroy the market. They can offer things for free. So if you're going to start a charting tool, you think it's great. So they're good. They're good. Can't now. They're very good. Artie, can I please clarify? Is one that has the disc? Oh no, we already did. So it's the discounted price, but the installment times 24, obviously. Oh, by the way, if Arti, just to answer the question to you, so if you go to campaignfor1million.com and you go there on pension calculators, it's really simple. We've got a great little is it worth it? You just work it out. Is it worth it? So let's say you've got 200,000 in your pension. You might have less, but no, let's just say you got that. You just work out the cost of it. If we do a 5% improvement for you, then the net benefit over 10 years is 202,000. Okay. The payback period on the cost of the program is 3 years. Your return on investment is 911%. If we, and it's out of our hands because it's in the hands of the market, what the improvements would be, 15% improvement, total return becomes that, then your net benefit is £1 million on a 200,000 portfolio, and your return on investment is 4,270%. Simple calculation. There you go. What else? Really good. Right. Thanks, Roger. Listen, I guess it's 11 o'clock now. We better all go. I apologize. I've taken so much of everybody's time. For those who signed up and to join the program, welcome on board. As I say, my ambition, when I set up the hedge fund 20 years ago, it was in parallel to my retail activities, and we took institutional money, and we still do. And we've now got Rootbridge in Switzerland, which is my private equity firm. Okay, and we've still got the other activities going on the hedge fund side. However, the retail side, people usually, when they go onto the institutional side, forget the retail and say, screw them. I've always loved the fact that I can communicate with private investors, not least because it gives an incredible dopamine hit when you get, well, I'll show you, when you get the reviews that you get. And we do video recordings of the reviews for that reason, because they're unbelievable. So people say, well, why would you do this? Well, one is I've got the ambition to create into $1 billion alternative asset management company, a challenger asset management company, where you manage your own capital, but you've got the data and the power and the education and the handholding to do it. But the other reason is so monetary. IPO it, $1 billion company, hopefully something new. But there's another reason, the massive dopamine hit of having some purpose, where you can see. And it's the only thing I can help people with. I'm not that good with digging, tunnels in Latin America to help people build houses or something. I don't think I'd be that good. And money, when you donate that, what you give away detracts from you. Knowledge doesn't. I can give away knowledge and it doesn't reduce my bank balance. It actually increases everybody else's. And that's why knowledge is just phenomenal. In that regard, it's great to be able to do this. Plus, all those books I've written, 18 books. Imagine being that irrelevant now. Great, I can convert those into webinars and give people all this free education at the same time. Okay, need to drop off. Thanks for going. Listen, I better go. Anjali, thank you. I'm delighted it was the first webinar. Listen, I'm going to go as well because it's rude for me to keep you guys any longer. Thank you all very, very much. I'm going to switch off. This is me saying bye. I'll do another webinar. I'll try and do it tomorrow, I think. with more of the charts and stuff in the markets. Okay, thank you.